Hello, this is Coach Mike from WinningStockCoach.com. I'm going to start out our market overview video for the week ahead, the week starting October 13th, 2014. First off, I'm going to kind of take you back in time to last week's video. One of the two scenarios that I had spoke of was viewing this chart. This is the DJI, the Dow Jones Industrial Chart. And I said that off of that bounce area that we had, we wanted to watch around that $1787.01, $17,087.01 for a potential area that basically, if we were going to continue up, we had to break and hold above to get another upwards continuation. Well, as you see, where the market closed last Friday to where we started out on Monday, we got right up into that target area and pulled back pretty severely from it. And we continued downward into my lower target area of 16,532.40 at the close of the week. So as we get into discussing the market overview for the week ahead, I want you to make sure you're paying close attention, because obviously the target areas mentioned and the scenarios are probably more important now than even in the past few videos that we've put out. Now, the chart you see here in front of you is the daily chart for the SPX, the S&P 500. If you've followed my last several months worth of market overview videos, I've talked about a pretty ironic correlation and a lagging period between the SPX and the RUT, the Russell 2000 Small Cap Index. And even though I've said it hasn't been a good historical indicator, it's been quite ironic, some of the similarities that we've seen. Now, a couple weeks ago, we had talked about a pullback target, 1932.65, as an area we would look for long entries. We got that bounce, we made the up move. But just like that DJI chart in one of those scenarios, was we had a point that we had to break on hold above, which we did not do, which actually led us down into what essentially could be called a double bottom. The close Friday gave us this double bottom. Now, the other thing I want to point out is this green trend line. This trend line's been pretty active on our charts for most of, not every one of, but most of the pullbacks over the past about 16 months now. And you see that we actually got that failure. We closed below it on Thursday. On Friday, from our open, we went up and retested it. Kind of a technical trader's reasoning to tell us on the retest that we were done with that trend line, and then pulled back heavily from it. Now, to me, in discussing the similarities to the RUT, I actually want to discuss a few scenarios, and unlike my normal market overview videos, I may be bouncing around on the charts more so than normal here at first, but I do want to go back to the RUT chart on the daily chart to the similarity that I am specifically mentioning. And it was a similarity where the RUT had a pullback larger than normal, but essentially had double bottomed in May, which had led to a double top. And that double top changed our severely ascending or upwards moving trading channel into a horizontal channel before what subsequently became a lower high and pretty devastating move over the past few weeks on the Russell 2000. So the similarities that I'm seeing, that I'm speaking of with the SPX, is actually in that double bottom pattern that we are seeing, and that pattern is what I want to discuss as scenario number one. Now, personally, I see the move that has been made as one that is already indicating to us that the trend has been changed. Now, one thing with me is I don't have necessarily a short-term perspective on my trading, and by that I mean, we can go up quite a bit and still not be in any other scenario than exactly what I'm mentioning, which is one where this uptrend has seemingly been broken. And on the break of that uptrend, even if we see an up move, that lasts several weeks, that I believe that up move will be one that produces a change in the overall market trend. So that's one thing I want you to understand, is that on an up move from this point, my personal belief is, in the best case scenario, you will not want to expect more than a double top, give or take a few pennies. You would not want to expect more than a double top. And in the case of an up move, you would want to use Friday's low as your support point, meaning if indices fall back below those Friday lows, you would want to stop out of individual stock trades that you might be trading, because should we lose the double bottom from our August pullback, the downwards move that we could see could be quite severe. I won't call it a market crash because I'm smarter than that. You see, what we have right here is not even a market correction, because a market correction would be a move to the downside of at least 10%. So I believe that further downside from here could give us the indication of a market correction, not market crash. Market correction could still come down even to this gold-colored trend line that I have marked. This gold-colored trend line has some relevance when we switch over to the weekly chart. From our October 2012, you see connecting bottoms, and should we lose that, we have this long-term channel, which would be the scenario of if you lose the yellow line, that gold-colored line, which we'll call market correction, market crash would be a further fall to the downside. So, scenario number one that I'll be looking at, and I'm one that is trained well enough in my own disciplines that I trade what charts are doing, not what I think they'll do, because sadly the people that trade what they think they'll do are the ones that usually get really disappointed in the results, and I'm quite pleased with my results. So should we begin making a positive move, knowing that through this sequence, when we came down and made a lower low, a lower high, a lower low, a lower high, and now a lower low, that even though it is possible that we break these highs, we have to anticipate at first a lower high to be made. So where would that lower high be? Well, should we hold Friday's low, we would anticipate a lower high be somewhere in the range of 1957.29, and based on prior accuracy from these market overview videos, we know that we're consistently accurate within 0.5%. So we'll say 0.5% plus or minus on the 1957.29. Should we get further downside, even though that downside, just like the current down move, which has had random green up moves, green candles indicating the up moves, that did not affect a downtrend whatsoever, I believe that in the longer term, not necessarily immediately, but in the longer term, we would begin to trend downwards towards this gold-colored trend line. And again, that is if we lose the double bottom, which even though we had a lower close on Friday than the lowest close of our early August pullback, we did not yet break that low of 1904.78. So we are still in that double bottom territory, to where a bounce from here would give that technical aspect of a double bottom. Now, I'm not a bear, I'm not a bull. You'll hear the Wall Street cliche phrase of bulls make money and bears make money. And by me having a level head on my shoulders, I can make twice as much by not letting my personal thoughts and whatever of individual stock movements be clouded by what stocks are actually doing. So if I was going to be a bear, if I was going to put my bear's hat on right now, one thing that I would really like to see as a bear would be a technical pattern called a head and shoulders. The head and shoulders pattern is one where you get a high, a low, a higher high, a low off of a double bottom area, and the subsequent, the third high in the series, would equal in the area of the high of the first series. It would be like looking at yourself in the mirror and seeing your left shoulder, your head, which sticks higher than your left shoulder, and then your right shoulder, which is lower than your head. And at that point, you become extremely bearish should you fail the established low point, which is often referred to as the neckline. So as we begin to watch the SPX, I would personally say that a bear's dream would actually be an up move into this area around 1985 to 1990 and a pullback from there. That would be a bear's dream. As far as the bullish side could very easily sit here and say that we haven't broken below the previously established support. And for all case in point, if we do make an up move on Monday, that the low on Friday is actually to the penny higher than that August 7th low, which would be called a higher low. And in that case, they would expect a higher high, but to the same percentage difference from the last high as this low is from the last low. So very, very simple representation to be made there, and quite frankly, what I believe 100% and how I will be enacting my own trade plans personally is that any up move from here would be an up move that lasted more than one day. As you can see over the case of these down moves, your solid green up candles, one day here, a doji candle, which a technical trader would say that's really an indecision candle, so one green candle here and one green candle here. If we were going to get continuation, we would have to expect more than one green candle, which also means that on Monday, I don't plan to do much to the upside unless what I'm doing to the upside is short-term trading or day trading. I might take some very, very minor risks, but for the majority of my portfolio, for the majority of my trading systems and trading plans, I would be perfectly happy at this point to wait until I can confirm there may be continuation, because people that try to catch a falling knife are usually the ones crying because their hands are bleeding. And by that I mean their accounts are bleeding, and bleeding to the red side, because they always are trying to focus on an aspect of trading that is virtually impossible to be consistent at, which is catching the bottom. And I really, really, really want to stress, and can't stress enough, that the importance in this upcoming trading week, if the stock market is going to make an up move, is that it'll make a move that lasts more than one day. Because if that move is only one green candle on Monday and Tuesday begins to pull back from it, you may look back and say that up move on Monday was just an opportunity for me to exit long positions or enter short positions, and to go into an approach on the markets with that neutral mentality, the aspect of realizing what is happening and not what you want to happen, is going to make your trading overall much more beneficial to you. Moving over now to our DJI, our Dow Jones Industrial Average chart. You see last week we had a potential upside target, potential downside target. We hit our upside target on Monday, we pulled back from it. We broke below the low and are now coming into that first potential downside target. Now, because of the up move that was made, it did create another potential downside target, the 16,422.79, that should we hold, we would look more like the SPX chart right now and not be breaking below our double bottom. Now, if we continue downwards, we have that scenario that we've talked about for a few weeks. If you remember, we had our target here, 17,306.26. We got into it one day and closed below it. We never closed above that target area. And for long-term trades, hey, I call that target hit. And we begin to pull back to our target pullback areas. Now, if we were to fail either of these two areas in the first couple days of the week, I do believe we would get down to this 16,103 area. More than likely get a bounce off this long-term trend line that, as I switch to my weekly chart, you'll see is a very consistent channel that the DJI has traded in. Now, I don't even think that we could call it market correction mode to come down into this channel. I think we would just call that an excellent opportunity for long-term positions should we hit off of that channel and make a positive move from. And because of that, I think, again, just like I discussed on the S&P 500, it is worth waiting a day for. Because if we do make an up move on Monday, and if the markets were to continue moving upwards, then they would continue moving upwards in a new trend that would last more than one single day. And if we do continue to fall, as we know, the media and other outlets will create a scenario that will make it a little harder to judge the rate of the fall. And therefore, smart money, I believe, will be in wait-and-see mode tomorrow as far as buying goes. My biggest, I won't say fear in the sense that I'm scared of the markets at all. You know, if you've followed my market overview videos each week, you know that fear is one thing I encourage you not to have. I simply encourage you to have a plan of reaction to what the markets do. Whether that reaction be it failed a certain point, I'm not willing to let stuff go lower, I'm going to sell long-term positions. Maybe it is, I want to protect myself a little bit, so I'm going to take in-the-money puts, one contract for every 100 shares I own to protect my long-term positions. Maybe that plan of reaction is it's time to go long or it's time to go short. And regardless of what it may be, based on scenarios that are very, very clearly presented before you on these charts, you simply need to react once it happens. Because if you've followed these weekly market overview videos, you've seen a high degree of accuracy. One that has made myself and members of the Coaches Roster newsletter at winningstockcoach.com a good amount of money. A good amount of money that you could share in so long as you're simply prepared to react based on a plan on what you see happening. Moving over now to the RUT, the Russell 2000 Small Cap Index, I have said for a while, especially once we indicated this lower high, that there's a greater deal of risk in small caps than anything else. Last week we talked about that if we continued the up move and we broke above those initial resistance points on the DJI and the SPX, that the RUT would have more upside potential than the others. And in reality, that is a very true statement. We made a move up. We did not hold above those initial resistance points, and therefore long entries should not have been made in small caps or anything else for that matter. But the RUT went from, as we switch to the weekly chart, a very steady, continuous uptrend. Now, this purple dash channel that you see, this actually started at the inception of quantitative easing 3, QE3. And since we've begun tapering from QE3, we saw that channel break to become more horizontal and now more downwards. And should we continue downwards, I believe we could easily see this 1023.97, and I believe any upwards move from this point, as I switch back to the daily chart, will be one that is limited to still a lower high, and thus creating still a greater amount of risk in small caps than there is reward. We've seen a lot of small cap stocks that have done well, And since the trend has changed in the Russell 2000, they stopped doing so well. Stocks like Zillow, Yelp. A lot of people don't realize that when you talk small cap, a stock like Zillow or Yelp is a small cap, but it truly is a component of the Russell 2000 index. And it's based on the market capitalization, the current price of common shares multiplied by the number of shares gives you a price amount. And that price amount, should it be between $300 million and $2 billion, would categorize that stock as a small cap stock. So with the Russell 2000, any up move should, if you insist on trading it, should just be looked at an opportunity for a short-term trade, a little quick flipper, and I wouldn't get my heart set on big-time gains in the small caps at this time, simply because the trend is set. The trend is set right now in a way where you are making lower highs. And when you see lower highs, you have to see it as a limit on your growth potential. You want to go long in markets that are making higher highs and higher lows. Because when you get off of that pace, when you get off or out of that mindset, all of a sudden your brokerage account, your investment capital, starts to become lower. Moving over to the NDX, this is the NASDAQ 100. Not seeing something that we like here. You know, we'd seen opportunities at momentum trades in the past. We saw great opportunities at long trades. We called in our market overview videos momentum trades here. We called momentum trades on the bounce here. We called investment opportunities here. More momentum trades here. Even told you to get out of them right over here. And this particular index has been falling greatly. Now, looking at where it finished out on Friday, I believe that it still has a very good possibility of double bottoming off of these lows over in here, maybe as low as this 38 area, 38.40, but more likely probably in the 38.50 area, 38.50, 38.55, and even making an up move back up to the 4,000 range, which, just like the SP 500 chart, would be the bear's dream, because it would give you that head and shoulders pattern we talked about. Now, one thing you can see on the NASDAQ 100 is you had a pretty clear trend since that March timeframe pullback. And if you guys remember back to March, you'll remember the media covering this pullback in the NASDAQ as the largest pullback since the tech bubble back in 2000, 2001. Percentage-wise, the move that was made was the largest pullback since that time. And here you are, nearly duplicating this move. And as you saw in that move, what did it do? It kind of based off the double bottom. So that's why I believe that scenario is highly likely that you do get this base in this area. The only problem I would have is, should we see that trend shift in the DJI and the SPX like the RUT already has, we could actually see a much lower fall should we be unable to hold this swing point in that 38.50 area. So again, same type of philosophy as I've mentioned a few times already. If stocks are going to move up and continue to move up, they will move up more than one day, which means for long entries, for the purchase of common shares, for the purchase of call options, you will produce for yourself a higher probability at winning if you allow the first day to happen. Don't be concerned with buying the low. If you make an up move and you want to maybe day trade that up move through calls or common stock purchase, that's one thing that's perfectly explainable. But to get your heart set on a long-term up move due to only one green candle, I believe that would be a pretty big mistake on your part. And the reason I say that is because, again, you look at this downtrend that's been made. You've had green candles during this downtrend. but yet those green candles had no effect on the trend overall. My biggest concern last week was the release of the Fed minutes. The first two line items of the Fed minutes that were released basically said that the Fed had concerns of the U.S. economy and concerns of the U.S. dollar. But stocks quickly rebounded on the third line item released, which was that they were not raising the interest rate. And the markets took that as a good thing and went up on Wednesday. I told members of the coaches roster that I wouldn't be making long entries on Wednesday, even if the market went up. That if they were going to go up, they would continue up, and I would wait until Thursday to do so. We all rejoiced and were very, very happy that we had waited, because it allowed us to use this down move for short-term trading Thursday and Friday to make a lot of money. I had members in the chat room. One individual member I was really proud of, he used $33 for a puts trade and cashed out with $546. One member on Friday used $100. Used $100 and cashed out his trade with literally $1,000 or 900% profit. And it was because of our identification that the news that was given with the Fed minutes wasn't positive for our economy. It was in fact the first time that they said they doubted our economy and they doubted the strength of our dollar. So amid all of that and all of the emotion in that one-up move that many people used as indication of a market bounce, we were able to not take losses on those long entries because, plain and simple, every up move that happened with continuation after confirmation. And anybody that's been following any given stock for any amount of time can clearly see that stocks go down a lot faster than they go up. So if we were going to make an up move, we would plan for that longer term approach at the steady and slow up move. But we didn't want to get trapped in a situation of a down move knowing that things go down faster than they go up. And on the down moves, we took advantage of short-term trading to make huge exponential gains simply based on the approach taken in this market overview video and every other market overview video that I have done. This is Coach Mike from WinningStockCoach.com, wishing you the best of luck in the upcoming week. And again, I don't want you to fear the markets at this time. I simply want you to have a plan of how you will react to the market and simply execute your plan, because that plan that you approach the market with, one that you plan when the markets aren't moving, when the market's closed and you can do so unemotionally, will be the best trades you ever make. God bless you in the upcoming week, and good luck.